Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. So, once again, we find ourselves asking that ever-familiar question, which way is the market headed? Hopefully our panelists can add to that conversation, give us a little bit of a sense of direction. Steve Reitmeister, our editor-at-large, our research director, Shiraz Mian, and market technician, Kevin Matris. Market doesn't seem to have any direction lately. Is this that correction everybody was waiting for?
Yeah, the high volatility, when it's spiking up and down so much, it's usually a bad sign. It's usually a sign that we're probably going to head lower for a stretch. Another thing that kind of points out to me as far as our direction here as we're turning around is that the Treasury bill rates are going lower, and that's kind of flight to safety move. And the Treasury bill rates were already pretty darn low, and so now they're pushing again to their lowest points in quite a while, and that's a move to me that people are maybe a little less, they're a little more risk adverse, and that's not a good sign for the markets either. So definitely in some kind of correction phase here. Don't know how long it lasts, but I think we got to press a little lower just to shake out some of the market excess.
But we can't press you for a percentage number, huh?
If you're going to ask me for a range, I'd say that the 200-day moving average, which is at Dow 10,200 and change, that's a pretty good stopping point. However, I sense it's going to just press below that to maybe about 10,000 just to scare everybody a little bit more and make them question that. But I don't see a fundamental reason for the market to go much lower. This is just some kind of correction that's kind of cleansing process the market has to go through.
Kevin, you agree with that? Or is there a technical reason for the market to go lower?
Well, technically there is. But if you look at it, the market indeed is at a crossroads. And if you were to look at the economic indicators, there is no denying that the economic indicators are showing great improvement here in the U.S. But the market seems to be preoccupied with everything that is happening overseas, and now everybody is wondering what kind of ramifications are going to be seen in the U.S. stock market and even the global recovery. Mm-hmm. So if you were to look at the downside, we have fallen below trendline support of 10.6. That happened 2 weeks ago, and then we slipped below there on Friday of last week. If you were to look at the next area of support, that comes in at Steve's 200-day moving average. That's right around 10.2-ish. Below there, you have psychological support at 10,000. Then you're going all the way back down to 96. Now, that is a very, very strong support level. But if worse comes to worse, that's probably where the market could go to, but we should find very, very strong support there.
Volatility the name of the game here for the foreseeable future?
Things are probably going to remain hyper volatile for quite some time because everybody's panicky. Nobody has any kind of real sense of direction. What's interesting, though, is that, if you were to look at that big 1,000-point plunge 2 weeks ago, shortly afterwards, you saw some stocks make brand new highs, but then you saw other stocks really start to crater out. So nobody really knows, but there's going to be opportunities across the board, but you really are going to have to really look closely to figure out where they are.
Shiraz, when we talked last week, it, by all outward appearances, anyway, seemed as though the euro was fixed. But then, in the wake of that recovery package announcement, and once the markets had a chance to actually digest pieces of it and get more information on it, markets focused on that euro once again, which is now at a 4-year low as we speak. So, apparently, the euro's not fixed.
My sense is that the initial problem which prompted the fears of contagion and which everybody was afraid of would drag down the global recovery, that fear has been fixed. The liquidity solvency issue that in the Mediterranean countries had come to the fore and was threatening to bring down the entire global system has been fixed with this bigger than expected European bailout plan. What is lingering in the market right now is this show me kind of an attitude that can these countries actually implement these very tough austerity measures that are needed in lieu of basically that. And it's that uncertainty. So the solvency and the liquidity issue is fixed. It is the effect of the resultant austerity measures on European growth which is bringing down the euro. And that basically makes me more sanguine about the market than Steve and Kevin. My sense is that the fundamentals here, both on the earnings front as well as the economy front, are far better than we see globally. So it should bring down volatility and should nudge the markets kind of in a favorable, positive tone over the coming days.
So you don't see all arrows pointing down on the stock market?
No, I don't. The trend that we have seen over the last couple of weeks may persist for a few more days, but my sense is that the market will digest the view that I tried to articulate, that it's the fear of the European growth, not necessarily the fear of the global financial system coming down. So we will get focused more on the U.S. outlook, which looks very good.
Ha 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 to both of you guys. So now investors sit back and hear three different opinions, two of which seem in concert and one outlying.
Okay, it's all a matter of time horizon. Okay, so I'm not disagreeing with the fact that there's not a good fundamental reason for the market to head much lower to 10,000. It's just that it's very clear the market wants to have a house cleaning. Okay, and that could be over this week. Okay, and so that's what we're discussing here is time frame. So you're a long-term investor. I think there's some great opportunities out there. You buy up great companies with the best earnings outlooks and reasonable valuations. Now valuations are starting to look attractive again. And you'll be fine by the end of the year. If you're more of a short-term trader, there is an opportunity here. There's going to be a down leg, most likely it seems, okay? And then because there's strong fundamental reason for the market to be higher, it will bounce. At a certain point, investors will say, enough is enough already with this down leg, and rational investing will reemerge.
I agree.
So does that mean that this correction is not anything to get overly concerned about?
No, not in my book.
I think the bulk of the correction is behind us now. There could be some lingering effects of it, as Steve alluded to, but I think we are pretty much close to the way it should have been. So the valuation numbers look pretty good now. The multiples are attractive now.
Kevin, don't get overly concerned here.
Yeah, I mean, it's been painful. It probably will continue to be a little bit painful, but I think that there's great bargains out there, and I do believe that by the end of the year, we will find ourselves at much higher prices.
All right, and remember, you heard it here first at the round table. Hopefully your week ahead will be a profitable one. Thank you for joining us, and with everyone here, I'm Terry Ruffalo.